Right. Good morning. It is now 11:13 a.m. and I'll call the Sewage and Water Board of New Orleans Pension Committee to order. Special counsel, please call the roll.
Director Kennedy,
Here.
Director Pacio,
Here.
Director Anthrop,
Here.
Director Thomas,
Here.
Councilman King, Ms. Shine,
Here.
Ms. Johnsey, Mr. McBoo, Mr. Joseph.
Here.
Quorum here,
Thank,
Chairman.
thank you very much. We'll now proceed with our two presentation items. Mr. Kwaku Obed with Marquette and Associates will present.
Great. Good morning, everyone, and Happy New Year.
Happy New Year.
And I'll be mindful of time, so I actually don't have too much to go through today, but I'll still be mindful of time as I go through these comments. Really cutting to the chase, 2025 was a good year for the pension, so you will see pretty strong returns across the board. I think, meetings where you're in the double digits, you're beating the benchmark, they're typically a lot shorter from a performance update. And then we also have some updates with respect to some of the manager contracts as well. So that's what I'll be planning on going through today. But we can see here that 2025 was a strong year. The S&P 500 just shy of 18%. You can see that the international markets significantly outperformed the domestic markets. A lot of that was really down to currency depreciation. The dollar did see some depreciation in 2025. So if you think about currencies, if you get more per unit of foreign currency for a dollar, that basically points to a lot of the tailwind that we saw internationally in 2025. And then you'll also see that fixed income was positive for the year. Interest rates did come down in 2025, and there's an inverse relationship between interest rates and the value of your fixed income. Interest rates go down, the value of your fixed income goes up. Interest rates did go down in 2025, so you can see here that fixed income was also up. And then at the bottom, you're going to see year to date, all of the sectors. When you think about the US equity market, the S&P 500, you'll see that everything was up year to date. So again, it was a pretty positive year as we think about the international markets, the domestic market, and fixed income. So as we look at the portfolio, pretty solid result here. We were up 16.3%. So the asset allocation, as you know, has a combination of equities, fixed income. It's a diversified asset allocation. So when all is said and done, 16.3 is a pretty solid result. And as we move further out to the right-hand side, you continue to see on the blue bar, which is how the portfolio has done, relative to the gray bar, which is the index, you'll see that we've outperformed over all longer periods measured. So again, a pretty nice snapshot of where we were as of 12/31. As we look at the various composites, you'll see for the 1 year period, so this is ending 12/31, you'll see that fixed income in line with the index. You'll see the equity composite. We were a little bit behind when we think about relative performance. So as you think about large cap, mid cap, small cap, ultimately certain segments of the equity market did better than others. Large cap outperformed mid cap, and small cap was still a strong performer, but didn't perform as well as large cap. So a little bit of a tilt towards small cap would have meant a little bit of underperformance versus the benchmark. Real estate performed nicely, as did the infrastructure composite. And then as we think about manager performance, really quickly, you'll see here, for example, pretty consistent and nice returns coming in. The index funds performing in line with expectations. And then a bottom performer, this just gives you a sense of how strong the year was, right? I hope every year I talk out bottom performance, I'm telling you there was a 17.3% return and the index was 17.4. That's just tracking error from the indexation. From time to time, you will see a little deviation between the index fund and the index. But all in all, you're looking at really, really solid outperformance from the top performers, and then the bottom performer, again, was to the tune of 10 basis points, which is very acceptable when we think about an index fund. Overweights and underweights relative to target, you'll see that the US equity composite, non-US equity composite, they've continued to be pretty healthy relative to target. The private equity composite, you'll see here that that will take a while to get to target. So that's the most underweight. And then you'll see that cash, we're actually holding a healthy amount of cash at 5.2%. So the rebalancing that we did, towards October, November, has also been helpful as you think about having a cushion within the portfolio. As we think about the fixed income composite, we will also look at rebalancing. So one of the things I will do when I circle back with Marvin in the office, I really wanted to discuss this with all of you, is the rebalancing. So fixed income has a little bit of an underweight. So what we would look to do here is still maintain the cash exposure, which is a proxy for fixed income, but rebalance a little bit away from equities just to shore up the fixed income allocation. So that's something that we would look to do.
Kweku, how does it work with the monies that we're waiting to deploy? They're not accounted for in the cash. Do they have a separate bucket, cash equivalent, or are we, I'm trying to see if that money is treated differently than our cash allocation.
To the cash equivalent, so
Okay.
it's getting a fixed return.
Okay. And so I think because the question becomes, we have money on the sideline. I think we want to show that we're still making money,
Absolutely.
those funds on the sideline.
Yes, absolutely. Yeah, so cash is still earning comfortably over the 3% rate right now. Interest rates are poised to come down, but still you're earning something on that cash amount. And it's viewed as a fixed income proxy right now because you're getting a very similar rate to what you'd be getting with fixed income without the volatility that we're seeing in the fixed income.
But when I see the 14.5, is that encompassing both buckets, or is that just our current, target cash? I know we're a little over our target, but I'm just trying to figure out, for example, our PE, our private equity, we want to get up to 28. And so I'm looking for 25 million. I want to be able to look and see where that 25 million is.
Yeah, so that 25 million, just very quickly, if the capital were to be called at any point in time, we would take from where we're overweight relative to the target asset allocation. So naturally, our US equity, non-US equity would be those sources of funding.
Got it.
Yep.
Got it. Okay.
And then cash would also be a source of funding as well. Here, this is just a dashboard and a timeline of actions that have been taken over the years within the portfolio. This is just a snapshot of the asset allocation, where we were, where we're transitioning to, so nothing to really report on here. And this just points to some of the transactions that have taken place over the years again. So there's nothing here other than informational items for your guys' reviews. Now, as we do start approaching some of the search activity, there's going to be an update on the contracts. So, every plan that we work with, once a manager is selected, there is a contract process we go through with the manager's legal team and the client's legal team, and that typically can take a little bit of time, subject to provisions, statutes, and the back and forth between the managers. So the good news is we have these 3 managers that have been funded, or I should say the paperwork has been finalized, and there is an expectation for funding with these 3 managers. These dates are tentative. It's always helpful to put the term tentative in front of all of this. Sometimes the managers will come back with suggestions on when they would like to receive funding. It can be more cost effective for rebalancing purposes and so on. But we're looking at, in the next couple of weeks, essentially, for Ernest Partners and Channing. Loop Capital has been funded. So these are the 3 of the 5 managers that were selected on the traditional side. The other 3 of the 6 managers that were selected on the traditional side, I should say. The other managers, the paperwork is currently pending, and there are still discussions ongoing between Swipno's legal as well as their legal. So we are working on it in terms of closing the loop with these managers. And the hope is, the next time we're here for an update, we'll have something a little bit more concrete for you. Now, in terms of why the paperwork is still in the mix with these managers, money managers will, depending on the language that they have to sign off on, they'll either sign it or look at revisions and go back and forth on revisions. There are some requirements with respect to signing off on some laws with respect to the state of Louisiana. You can see that for GQG as well as TS&W. With Mesro MetLife, it's a little bit different. So Mesro came in to present, and then they were acquired by MetLife. So my understanding is a couple of things need to happen. We, as Marquette, can affirm that we maintain our confidence in the legacy Mesro team that was acquired by MetLife. And we have, informed our clients following placing the strategy on watch that this is a strategy we remain confident in. And then outside of that, I believe that legal is just going back and forth with MetLife and their legal department on signing off on certain paperwork.
Why is it taking so long? This has been
been a-
in
it's
hopper
been a-
for a long time.
Correct. And I would really just put this down to the legal back and forth between the managers and the legal team. I think there's an understanding at this point with the managers because it's taken so long, and we want to really just reach a conclusion and not continue to go back and forth.
Who is the onus on now? Who is the onus on? You've done what you needed to do as Marquette, correct?
Correct. Yes, the onus is on the managers and their legal team, and really just getting back to Swibno's legal in a timely fashion with respect to closing the loop. So one of the things that I think is on the table is if there's an unrealistic period of time at this point with any of the managers, I think we'd have to entertain pausing, pulling the mandate and figuring out if there's a more time-effective solution for us. And managers are typically more receptive once that's on the table, knowing that, look, this could go away as an option.
So I think one of the things that I go back to in our process, through the filter that Marquette provided us, we had quality managers that we evaluated. No one was lacking and couldn't deliver what we needed. And so I'm really concerned that GQG and TS&W are having this long period of back and forth. I'm also wondering if in the future, as we choose managers, if we can have our legal information in the procurement, because why are you bidding on business and you don't know if you want the business, right? I suspect most people here, especially those who have money invested in the fund, are ready to go to the next choice if they cannot immediately resolve this with legal. There hasn't been anything that's come back that says that we've created something. It's Louisiana law, right? And I keep looking at Mary because I know you work on this.
Yes,
So,
that's correct.
so
There've
we're
been meetings back and forth and shared correspondence with the legal teams. Yesterday, there was a call with GQG's legal team, and I think we're going to get there.
okay.
With a little encouragement on the business side from Kwaku. TS&W, we're optimistic that will be resolved as well. Mesero and MetLife, we're working on language with them to confirm that the transfer and the acquisition of the business unit
Yes.
was sufficient to survive the procurement. And I think we're going to get there. It's getting them and getting the language agreed to.
Yeah, I get that Mesro and MetLife is an anomaly. The
That's right.
timing was just
Yes.
unfortunate. But I have serious challenge with the process that we are having to undertake with GQG and TS&W. They're putting us through, a difficult process to give them money. I don't understand that. And so I think we need to revisit how we go through this process.
Yeah, I think to that, one of the things we can do for the next round of searches is perhaps have the paperwork sent to the managers in
Yes.
advance. And they can come back with red lines, pushbacks, any edits that they have. And then that could go to legal, and there would be an estimate at that point and at the table as they're presenting on, rough timelines that they could deliver on.
Yes.
In this particular instance, I think the surprise here was, the pushback on the state law. That kind of came out of left field, particularly given the fact that there's not much anyone can really do if it's
That's-
state statute. But again, in learning that this was a hurdle, I think going forward, we'll make sure that the paperwork is part of the finals
Yes.
discussion. And then managers really saying on the record and committing to a reasonable timeframe will allow us to factor that into the decision as well.
I think,
So just for clarification, with small cap, with infrastructure and real estate, are we saying that's exactly what you're going to do? To have that information pre-prepared?
Yes. Yes, so when.
Because we're coming up to make a decision in those two areas, right?
Correct. So when a date has been set and the managers are coming in, we would, as part of the presentation, ask the managers to perhaps have a page or a section where they've reviewed the contract, and then they can flag anything that they may have exception to, anything that could add some time to the process. So at least we have that discussion at the table. So we'll go through the firm, the team, investment process, and then the other area would be the onboarding and paperwork. So we could assess their responses on that as part of the conversation.
because to me, it's really a surprise. If they're coming to do business in Louisiana and they don't know the Louisiana statutes,
Right.
that is a red flag itself. And if they are not comfortable with the language of our statutes, then they shouldn't be entering into the business.
Yeah.
Yeah, because that's a non-negotiable.
Right. It's not a
like
sui
changing
generis-
US Constitution or state constitution, you're coming to do business in US and you say, oh, by the way, I don't like this clause of the Constitution.
Yeah,
Yeah, correct.
all right.
So that's where we are, and I would say that, in terms of the next round of discussions, that addition to the process should eliminate a discussion like this as we're thinking about the other asset classes.
Can we put down a, solid deadline for them to either back off or move on?
Yeah, I mean, I think.
Because it's been dragging on too long. Look,
Yeah, I think with legal, if we are looking at, let's say, the end of February, I think that seems more than reasonable at this point
We
to
can
have
still
everything
convey
concluded
that
by.
message.
Yes.
Yeah, if that's the pleasure of the committee, then,
Yeah,
that.
I think
message conveyed.
whatever urgency sounds like from the legal team, I think we want to communicate urgency, or we are more than happy to move on.
Happy to do that. We will do that on the legal side, and if you will do that on the business side, that may be more effective.
Yeah.
But we're happy to
Absolutely.
convey that. Thank you.
So should we make a motion or?
It's not actionable.
Yeah,
It's not actionable, yeah. All right.
Quickly, this has not happened frequently in the past, has it?
It does
It
from time to
does.
time. I would say I've had, not for you guys, obviously, but I want to say I've had an 18-month negotiation with another client. It can happen from time to time, and I say the difference is it's not always the manager. Sometimes it's their legal teams, external counsel, and external counsel, depending on their interpretation, may not do favors for the manager that they work for. And I think in this particular instance, certain legal teams can get so obtuse about their interpretations, their read of things. At the end of the day, these are all regional firms. They have assets globally as well as across the US. They've signed off on many state statutes, and my take is just sign off on this. It's the client's money. But again, it depends on which lawyer you get, the luck of the draw. And from time to time, we will run into situations where the legal process can hold things up. So we're not that unique in this particular respect. But I think going forward, going into these discussions, I think there'll be a clear understanding of, we'll select the top 2 managers in every category. And should we go through a situation like this again, we'll be in a position to start contract negotiations with a second choice and eliminate the first choice, just so we can continue to keep things moving.
Just a question, Dexter's comment about a motion, I don't want to forget about that. But legally, is there anything we need to put in writing? For example, when we meet about real estate and infrastructure, already have a document that states what the plan is, according to what Kwaku stated?
I mean, well, currently, right now, we're in the negotiating period with them in terms of these hiccups that they've kind of introduced to us. So there won't be any need for any motion, so you're suggesting some kind of.
No, I was
No, you're
I
talking
was
about
just
the
fol-
next group.
Next group, next
So,
group.
so,
Going forward.
yeah, going forward.
Sure.
So going forward, if, from what I'm understanding, Louisiana choice of law or venue clause is gonna be standard for everything that we have. And then the open request to include an addenda or a side letter to be governed under laws of the state of Louisiana. That should be something that we can get an answer. It doesn't take a month and a half. If you say no, we should know how to move forward, correct?
That's,
At least, and that'll knock those 2 out.
and that's what we're saying. I think when
Immediately.
Kwaku does his filter,
Solicitation.
does the solicitation, we would like to have this
Have that
included
clause.
so we know up front you're ready to do business in Louisiana.
Correct.
Yeah.
Right?
I think we could draft in the resolution some documentation to indicate these specific terms. So
Mm-hmm.
with the manager will be clear, because that's the document we provided them indicating the board selected them.
Mhm.
And then we'll add that documentation.
We want to go before we selected them, right?
Yeah.
In the
In addition to
solicitation.
the pre-work.
In solicitation process, you gotta lay it down that, hey, you coming, if you accept these rules, walk in, if not, bye-bye.
Yes, yes,
And
correct.
to Gray's point, we've also run into situations at times where during the marketing process, they'll say, yes, we can, and then it gets to the contract and you run into a situation. So doing it at the front end and then also at the
Yeah,
back end
I see.
also allows us to make sure that we're keeping them honest. So yeah,
Sounds good.
absolutely.
Good.
Yep.
Yeah.
The next few slides here, I can skim through. They're just a quick recap of the structures of the firms that we just highlighted, and then the presenting personnel that came in. So this is just really there for your records.
So let me ask you, as far as MetLife acquiring Mesro,
Yes.
would their focus be changed? Because MetLife is a huge
No.
No, so it's actually,
focus group is gonna be the manager's focus group is gonna be primarily the same, or is gonna get mixed up with
so
other?
it's going to be the same. So small and mid cap is the specialty of this team. And the deal with MetLife actually came about because MetLife's equity platform was not as strong. Traditionally, insurance companies have really strong fixed income platforms, but on the equity side, not as strong. So I think this actually works out
To
really well.
diversify that.
Yes, it works
portfolio.
out really well in Mesro's favor because they were wanted. And then the team is given more distribution and more resources to manage the fund. So it's actually viewed as a plus in our opinion.
Thank you.
Yep. So with respect to the next round of searches, I know that we did isolate, a handful of managers in both categories to take a look at. So, on the infrastructure side, we'd be looking at these 4 firms: Brookfield, IFM, JP Morgan, and Macquarie. So these are the 4 firms. All of these firms, they continue to be best in class, in our opinion. We continue to recommend them to clients, and we continue to think that this is a very strong lineup of firms to interview. And then
So you're recommending 4?
4 to bring in, and then of the 4, we would be looking at potentially 2 managers to bring in.
Yeah, before you bring then these 4 potential, could you please run by them?
Yes.
Because we don't want to waste their time and ours.
Yes. So between now and the next meeting, what we can do is follow up with these managers. I'll work with Gray to get the language just to make sure that, even if they have edits or addendums, that's fine. It's a simple yes or no. At the end of the day, will you abide by this? So we can follow up with them to have that as one of the screening criteria.
Yes, sir.
Yes, so we can definitely do that.
In each of these cases, you're recommending, of the four, you're recommending just one? Or in the past, we've done sometimes two?
So
So they
potentially
should be informed, if two is a possibility, they would be informed of that by Marquette?
If we're gonna hire two,
Yeah.
if they ask, we typically don't, we'll typically just tell them that there's gonna be a finals, and then the selection, we may end up going through the selection and saying, you know what, when all is said and done, we're comfortable with just going with one manager for the whole allocation. So we don't want to set the expectation. We want to give you guys the flexibility down to the wire to go with either the one or the two. So we can tell the manager, it could be one, it could be two managers we hire, but we don't get that specific, because again, at the end of the day, it may be more economical just to go with the one. We may feel that the one is more adequately diversified, so we want to explore looking at two, but one may ultimately be the option as we think about infrastructure. For real estate, the allocation is a little smaller, so one would be the optimal allocation for the real estate allocation, as opposed to splitting it between two. That's our thought. But again, the flip side might be, we go through the conversation, you guys might say, look, at the end of the day, we don't want to put all the money with one manager, let's split it between two. So we try and keep it pretty flexible.
Because we've done that in the past.
Yes.
Correct, yes.
Sir. So as far as the ranking of these fours, you put the first highest performer first and then subsequent, or how do you rank them?
No, this was just alphabetical.
Oh, okay.
Yeah, this was just alphabetical. All of these managers are really solid. IFM would have the longest track record, then JP Morgan. Brookfield has been in the industry for decades, but they have a newer track record on the open end side of things. And then Macquarie's a little bit different. They have a longer term track record, but again, they are one of the newer strategies in this particular space. So pros and cons to all of them, but all of these are solid managers.
Okay.
The pros would be the more mature funds would have more of a longer return stream, so you get a sense of how they do across a different cycle. The newer funds would have a little bit more exposure to your digital assets, meaning the AI story, the cooling and digital storage. That would represent a bigger portion of their portfolios, which is good and bad. Good in the sense of it's a new theme, bad in the sense of if we're in a bubble, you have a bigger portion of the portfolio allocated to that. So those are the broad pros and cons, but these are all really, really good candidates. And across different clients, we have a lot of exposure to them, which is nice.
And Kweku, they all will be coming in person to present?
Yes, that would be the plan, yes.
Okay.
Yes. And then on a similar front, these are just bits of information we went through in the past, just updated. And then these are the fees. Again, all information that we've gone through in the past. And then these are the three real estate managers we discussed. So same thing with them, making sure that before they even come in, there's a look at the language, there's an affirmation or any flagging that they have. And then these three firms, again, all solid firms as we think about them. The one that's very different across the three is TA Realty. This is a big fund as well, but they are newer, relatively newer. Their track record, a little over a decade, and because they built up over a newer time frame, they have more exposure to the Southeast versus your Principal and Clarions that have more exposures to your New York, San Franciscos, and so on. But again, all three managers do a phenomenal job, very diversified, and again, significant client experience with them. So with that, I would conclude my comments here, and happy to take any questions that you all may have. But the next steps, unless you guys tell me otherwise, would be to follow up with these managers, tentatively work with Gray on some dates. So I think we would have 2 sets of dates to meet with the managers. I think meeting with 7 in one day may be a little bit too much. So we're probably going to prioritize one asset class over another. I think infrastructure would be the one we'd want to go with first, and then real estate. as the second option. So those would be the next steps that we'd have.
Sounds good. Thank you, Kwaku. Any other questions or comments about presentation? Okay, great. Thanks again. Next, we have a discussion item, the 2025 annual COLA study. We've seen this material before, but this is an opportunity for trustees to just discuss some of the findings, see if there are any other questions that need to be asked. There's no action to be taken today. Just to discuss and see if there's anything else that we need to revisit in this effort from the COLA study.
Sure, I can start. So if y'all look at page 13, that kind of gives a summary of page 12 gives what each option is, and page 13 kind of gives the cost and impact, kind of to the funded status. If you look there, that kind of is what we're looking at the bottom, and the impact of all these options. I know they were presented by the actuary, and we just casually said that we'd talk about them again, so I asked it to be on the agenda so we could discuss it on if this is something we wanted to talk about as a committee. If so, what potential options could there be? Because you can select more than one. What can our pension bear versus not, and what we think would make the most impact, right, to all the people in our plan. So I just kind of wanted to throw it on there so that we could talk about it.
So is Mitchell going to, at some point go over this, or it's just up to us to go over?
He did already. So we got this
This is for us.
presentation. He presented this back in, October. And so some folks had some questions, and if we have specific questions that we can't answer here, we can forward those questions up to Mitchell. Right. I think one thing I just want to be clear about, Gray, you may know as well. So when we look at page 13, if you recall, we had the 5 different scenarios, hypotheticals, to illustrate what would happen if you increased the COLA cap to 4%, so on and so forth. And if you look down, you can see what this will approximately cost in dollars and how it would ultimately impact the funding status. And they're all in silos. So if you did more than one, that would be a cumulative effect. All of them have a cost. All of them would reduce your funding percentage.
Yeah, so option E was not applicable because we couldn't find a standard in Louisiana, so you can kind of cancel that one out because we didn't have anything to use. But the options on the table were, A through D. Of course, D is the most expensive option, and there was concern expressed at the last meeting that that's not something potentially that it could bear at this time, but the smaller impacts were the first 3.
Well, your option E was in lieu of, and I see you raise your hand, so they couldn't find a standard for Louisiana, but I think the imperative lesson out of that exercise was you can set COLA to be whatever you want. This is illustrated as 1.1 of CPI, as opposed to just accepting CPI. You could say 1.25, that would be a higher number. But this is, you can absorb, you can basically get a 10% increase in cost of living for this cost. I hope I'm not oversimplifying that, Gray. Is that?
Yeah, that's what they were commenting about. That's a way to modify the COLA in a different way. Not that it's off the table, but that's just another variation. Yeah.
So we don't want to eliminate COLA.
That's what I mean.
Sorry, I didn't mean to misspeak. We just didn't have a standard to go by, so it would be a number that someone would have to come up with instead of a standard that we could go by.
So forgive my non-information for this. So once it's selected, it's for what term, or is that indefinitely? Like how does that?
So how the COLA operates now is on the first $10,000, it's up to 2% based on the CPI, and that is paid in a one lump sum to everyone that is a retiree over 65. And that happens every year. It's capped at 2%. And so some years we're over that, some years we're under that. And so we asked our actuary, can you look at options we have around the COLA? Does this make sense? Is this meeting the market? Is this what is the best thing for our pension and for, our pensioners and for also, our fund? And so these are the options that were discussed.
Changed at any point after that, or how does that work?
Right in the rules, how the COLA is set up. And
Yes.
so we'd have to modify the rules every time the COLA was redesigned. And so, we don't have action on this, so even if this was just to discuss, and then if we wanted to potentially go down that route or have additional questions for the actuary, we'd have to do that at the next meeting.
I heard Becca say that we had more than one option, but we don't account for that in these different scenarios. We took option 1, current plan is 71.2, but if we took option A, it would go down to 70.4. But if we took A and E, what would that result be?
So if you look at that, that's 71.1. That difference from the current plan is 0.1.
Right.
And so if you see where 70, if you look at, go to option A, it's 70.4, reduce it another 0.1. That's the cumulative effect.
So
If you chose both of those options, you add it on.
you add it on.
You add it on. If you choose B and C, same process. Or if you choose 3 of them, you just add that delta, add that difference. And that's the reduction in funding status that it would cost you, right? Which, of course, the reason to discuss is you may decide that's worth it, right?
Right, so this goes back to the quality of life of our pensioners, the reality of stagnation. That's why you have COLA. I know we don't have this, unfortunately, for our active employees, but at least we can talk about it from a pension perspective.
If you recall, there was a slide, and it may be included in here. You had a historical on what cost of living, what CPI had been for the last 10 or 20 years. And so you would see in the years that inflation was less than 2%, you matched it. When it was 3% or more, you were capped at only 2, right? And so that's your first calculation to determine what would it be to move that cap from 2 to 4%. I think there were only a couple years in the last 20 years where that would have applied, but here's what that would look like if you adopted that change. You don't currently get COLA for early retirees. Option B in column 3 illustrates what it would cost if you offered COLA to your early retirees. And you also didn't have too many of those folks, so I don't think it had a huge.
Significant effect, yeah, because
Correct.
the numbers are same.
Correct. And I'm sorry, that's actually 4. C was for disabled retirees. I think that's just, they're very few, but yeah.
Be impactful, yep.
That would probably make a huge impact for a disabled retiree.
For them.
Yeah.
So option A, it's 7 times the CPI was greater than 2% since 2006. It's on
Okay,
slide
7 over
5.
20, yeah. 7 out of the 20 years, it capped over 2. So that's significant.
So, my perspective is if it is a benefit to our pensioners for recruitment, retention, and just quality of life, and our pension can bear it reasonably, I'm hoping that we can look at some of these to implement, right? Some of these have very small impacts and will have huge impacts to our pensioners. Like an example is option B, the pre-65 COLA to disabled retirees. It's a very small impact and would have a huge impact on their quality of life. And so, you know, my perspective is that would be a really easy one for us to say, absolutely, let's implement this. You know, of course, the $10,000 restriction is a big one, the biggest impact we have, but some of these other ones, maybe we could ease into a change and see how it works and see if it impacts them, and then see how it works if we want to change something else.
Yeah, I don't know, do you all meet with your constituency groups officially, or is it water cooler talk or just network? You know, I think these are the types of things that you all may want to discuss, or how does that?
Is there like a poll that goes out to them?
That's what I'm asking, when you know.
See, unfortunately, we don't have any venue where we meet our retirees.
Okay.
These are focused only on retirees. It's not, you know, the
Sure.
current employees. So unless we have some event, we can get a feedback. Other than that, maybe our PR team may have, from the Katrina commemoration event, we may have their email addresses and stuff. We can send out a blanket email to all the retirees and see if they have any feedback within a certain time.
I do have one question, and maybe you know, Gray, if there's any policy change, any of these or combination, would that, my belief is that, but I want to make sure that would impact all current and future retirees? Or would this create a starting point and this only impact future retirees?
Yeah, typically, like, going forward prospectively, yeah. So,
Okay, so this may not even impact current retirees based on these calculations?
yeah, we can follow up with Mitchell on that specifically, but yeah, depending on how the amendment is written and.
And what he did the calculation off of, right?
Said it wouldn't be historical, but it would have a starting point.
Okay.
Like if we
he
started
said,
next
then that answers it.
year.
So it doesn't
Yeah,
impact
moving
retirees
forward.
at all?
Moving forward.
No,
we will give-
the payments would start next year.
Oh, this payment will start, okay.
But it would affect all, my understanding was,
Retirees.
it would affect all in
All
retirees.
retirees, current and
In
future.
Future.
Right. Well, they would start
Yeah,
going
sure.
forward.
Okay.
Because to the best of my knowledge, correct me, we don't have any COLA for any of our current retirees.
Yeah.
No,
Yeah.
there is a
We're
COLA.
only one person,
No, there's a COLA on the first
only
$10,000.
65 plus.
Correct.
Correct.
5+.
Yeah, and he has in here how many people are affected or in that bucket. So we know how many people it is. And that's how we got these numbers. But this was, you know, what this committee asked, it says, how can we make the quality of life better for our retirees? And the changes to the potential COLA are what came out of that discussion. This discussion's been happening for years now. We have the data. And so that's what I'm trying to push. So talk about what our next steps really are.
Right, and to Moby's point, there really is no formal communication with retirees. I represent the retirees, so when I see them or they reach out to me by email or, you know, on Facebook and ask me what's going on, that's kind of like my communication with them. But as a result of the Katrina memorial event, I believe Sierra did get most of their contact information. So are we asking retirees for their input on this, or are we gonna let this committee decide and tell them, hey, this is what we decided?
See, Stephanie, you got something for us?
So as far as communicating with retirees, we have established a pensioner's email address, but of course, all pensioners do not have email.
Yeah.
The primary method of communication with pensioners is mailing out. If we have something to mail out, that's what we do in benefits. If we have some type of flyer or communication, all pensioners receive paper checks, documented check stubs, even though they receive direct deposit. That's primarily the way we communicate with pensioners. We put it in their check stub, whatever type of.
And I forgot, they just created the retirees newsletter.
We have that
I'm
newsletter
sorry.
that goes out, but it
my
goes to the
bad.
pensioners, but you know,
Yeah.
of course, they have to have email addresses. They're older, everyone doesn't, so we still have to mail out to them.
Yeah.
Is there a possibility on that newsletter that a poll can be created for them? And even if it doesn't hit everyone, you know, we would hope to hit everyone, even if it's a actual mailed out, you know, flyer or what have you, but at least to get that poll data. And I think that'll give us the warm and fuzzy on the direction of the majority of what they'd like to see, because it directly impacts them.
Definitely.
Right, because I think the main thing that a few of them talked to me about is removing the $10,000 restriction, and I see that's probably not
Not
feasible.
viable for.
Right.
So if they was to choose that, then this board and the trustees would have to still vote, and our vote would be the determination.
Yeah.
Even though we get there, we check their temperature, but we still vote because we are trusted with.
Gotta do your fiduciary
And we
duty.
probably have to have the actuary come back to discuss the true impacts based on the option, right?
I think that, we're in that situation where we get to see our two different roles. I'm not meeting with active employees or retirees.
Yeah, as a
My-
board
I'm not
member.
going to recommend anything that reduces, I don't have a skin in the game, so to speak. I'm accountable to them, but I don't have the opportunity to engage. I think you all have the opportunity to test the waters and see what the temperature is, because, even a small move, it is a significant move, right? You're changing the fundamental benefits of the plan at the expense, even if it is measured and small relatively, of the funding percentage. And so I think you want to do that knowing that that is the will of the people you think you're accountable to. That's-
Yeah, I think what's,
But I would like to add too, though, that if it's the pleasure of the committee to do some kind of polling, that we in the legal department at least have an opportunity to vet what that message is.
Yes,
simply
yes.
Because we're talking about some.
Absolutely, absolutely.
And can they rank it possibility, just so that it's not indefinite? And the reason why is if everyone has one that's not feasible for the committee, it's just like, hey, this is gonna be too expensive. At least we have what is the greatest second option, or the great, so that way we know the direction.
yeah, it seems to me like what started as a relatively simple question has become much more complex as we've started to see the results of what our advisors have given us. And I think that it presents an opportunity for us to have more conversation with our existing employees and our retirees around what the goals of the plan are. Because I think it seemed like it was a simple question of, let's make our quality of life better for our retirees because their pensions are losing their value based on inflation. But, is that ultimately the goal of the pension fund? Should we be thinking about what our employees' existing contributions are relative to those goals? If there is some sort of broad agreement amongst our existing employees that they would like to see a more robust pension in their retirement days going forward, or are they willing to contribute more to that fund today in order to balance those changes in the long term? So I think that it's important that we engage more with all of our employees, not just the retirees, to understand, we're saying we probably can't support the 10% cap lift, but we could if we increase the employee contribution to the fund. And if the employees wanted to do that, then we could do that.
Or we could change the amortization schedule as an alternate. It doesn't have to
Exactly.
be an increase.
There are many options that we could look at. And so I think it does elicit maybe some visioning around what it is that we exactly are trying to do, so that we can determine if this is a path we want to go down. Do we want to try to find a way to do it? Or is this not the path we want to go down, and then it doesn't require sort of additional options that would need to be?
And those two different groups, the retirees are just getting distributions. They are not contributing anymore. The active employees are contributing, right? They're in that sense, the retirees had skin in the game when they worked, but right now, they're just getting the distribution, right?
Why you look
So-
at Jackie like that?
Right.
What?
I'm messing with
Sorry, Jackie, that was just a natural.
Wait a minute.
Why you pouring it?
But anyway, but they're just getting the distribution, so they're not contributing. So we have to weigh those two groups, right, when we make these decisions. But I agree that we should discuss, and people who have the foresight of, I'm going to retire, and I want the $10,000 limitation moved, and I am willing to pay more as a contribution. We need to weigh all that in.
Stephanie, I'm sorry. What does engagement and communication look like for a pre-retiree? Or do we have like an annual pension FYI for active employees, or is it just, I'm gonna come visit benefits when I'm approaching retirement, and then I'm gonna start to learn? Like, what is that like?
So they're always just popping into our office. Traditionally, we've done lunch and learns, a few throughout the year just for engagement. Last year in 2025, we were able to actually have satellite offices where we had an HR representative on site at Central Yard and at Carrollton. And then we were there pretty much every day, all day to field questions and operations.
Okay.
At that time as well.
Stephanie, don't you have an annual benefit statement on through a website available that?
So we do. So last year, we were able to go live with our pension portal, so that any active employee at any point, they're able to log on to the portal and they can see their years of service, you know, what their potential pension looks like. The only thing they wouldn't be able to see is if they had any leave without pay. And then they could contact us directly and we work with them from there. But that has given employees a pretty good idea of what their pension will look like prior to retirement.
And I just have one more question in that space. I know you all have to campaign for your spots, right?
Yes, active employees.
Active employees. What does that look like?
Putting out a flyer, going to every destination campus we have.
Okay.
And laying out our platform why we think.
Put on flyers. There's no like forum or meeting or anything.
No, but we go out, right? Like in networks, they leave out on a cruise 7:30 in the morning. We go out there at 6:30 and ask the managers, can I meet with your employees? They give you a few minutes before these guys get on the truck in a safety room or something.
Yeah.
And you just call managers and tell them that you want to come out and meet their employees and lay out your platform. So that's what I did, and I imagine that's what everybody else did.
Yeah.
And that process starts with each candidate has to have 25 qualified endorsements. Basically, you know, so many employees have to pretty much, you know, say that they would support you. They have to be active employees. They can't be any temps or contractors. But once you meet that minimum requirement, then the employees are able to go out, and pensioner. There's 3 active employees, 1 pensioner. They're able to go out and campaign.
Got it. Okay. Cool. That's all my questions. All right.
When do you want to conclude this?
This is just for discussion, and you
No,
got.
what I'm saying, if we can put forth some deadline where we have to make a proposal and vote on it.
There isn't. It's just wide open. You can take action, not take action. This is just so that everyone's on the same page of understanding of how to interpret this report and have discussion however you see fit.
Okay.
All right.
So who's gonna develop the survey to
You-
send out to the retirees?
You all would first have to decide that's what you want to do.
What option are we putting forth for them to accept? That's something we had to work out of these 5.
You've got umpteen different options of how you can move forward.
From Trustee Joseph is that the retirees really don't even have skin in the game. So they really don't have, that's what you said, skin in the game, right?
We went down a different path now.
We need to send a survey to them, so we want to take the temperature of the room with current employees to see how willing they are to choose one of these options. That's fair.
I think what I was trying to say is that when you come to increasing the contribution,
That's a different thing.
yeah, because if retirees don't contribute to the plan anymore.
Right,
But
right.
all of this.
That's what I meant. Not that they didn't have skin in the game, because
Right.
their years of service definitely gives them
We
skin in
had
the
skin
game.
in the game.
I'm gonna help you out since I messed it
yeah,
up for you.
Yeah, yeah, so I did not mean.
This applies to everybody.
Yeah,
Yeah, so
shouldn't
ret-
it go out to everyone? And that way.
That's what he's saying.
The
No, this would.
majority,
Yes,
yeah.
I did say that.
This would.
Okay, so.
These
the
scenarios,
majority,
everyone.
So retirees listening to this meeting, next to do believe you have skin in the game.
Yes, yes,
And I
yes.
represent you too.
Everything in this work product, it applies to everyone, active and retiree.
Yeah, but so it could go out to everyone, the whole survey, could go out to everyone.
I just want retirees to be involved.
Me too.
Definitely.
So I just wanted to piggyback again on the retirees being involved, you know, although they're on a fixed income, they do see slight deficiencies or decreases in their pension per se because of the health benefit deductions that they pay. They're on their fixed income, but for example, this year we increased the benefit, so that benefit costs a little bit more for the health insurance, so they see a smaller portion of their pension. So we just have to be mindful, you know, that they would be impacted and affected.
You have to be in the loop.
Got it. All right. Any other questions, discussion, comment? All right. All right, that was good and informative. We also, well, we have some information items for everyone. Is there any public comment?
No public comment, Chair.
Awesome. No public comment, no further business before this committee. I'll entertain a motion to adjourn. Moved by the trustee Makbul, seconded by trustee Joseph. All in favor? Any abstentions? No? All right. Motion's approved. Meeting is adjourned. Thank you very much.
Sure, thank you.